As we're heading into February, the market has been in a serious decline, which is starting to open up some really interesting opportunities for us, guys. In this video, I'm going to cover 3 stocks that I think you should be really keeping an eye on. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys? And before I go into any of these names, just remember that this isn't advice or recommendation, so do your own due diligence. This is more of an explanation of what I'm seeing in the market, and if you're interested in any of the names mentioned on this video, talk to your investment advisor to see if the names are right for you. Now, the first stock that I'm going to cover is a stock that I have covered on this channel before. It's Rocket Mortgage. This is not for the faint of heart. This stock has absolutely been crushed over the last little while, and this is because the Federal Reserve has signaled 4 interest rate increases and business is expected to dry up. Needless to say, the medium term for Rocket Mortgage will be very rocky, despite them being the nation's #1 home lender. Some of the things that I really love about Rocket Mortgage is that they have the highest retention rate at 90% plus for the last 8 years. So when they get a customer, they're really good at keeping that customer. And for a mortgage company, that's really saying something because customers are usually driven exclusively by the rate that they can achieve. So Rocket Mortgage is definitely doing something by keeping costs low so that their interest rates can be competitive with their competitors. And what I like that Rocket Mortgage is doing is they're not just hanging their hat on their mortgage origination business, they're also growing product diversification, including Rocket Auto and Amrock. They've also grown market share from 1.3% in 2009 to 8.4% by the end of 2020. And Jerry Farmer, their CEO and somebody that I absolutely respect, is targeting a 25% market share by the end of 2030. Even if they grow at half that rate, they're a strong buying opportunity right now based on the price. Now, make no mistake, volumes and margins are coming down, and the next few years are expected to be very challenging. So this really is a buyer beware situation. I'm currently valuing Rocket Mortgage at approximately $28 a share, and so at the current price of $12 per share, this provides quite the compelling opportunity for investors that have the stomach for it. And if you're looking for more downside protection, the cash secured puts are yielding really good sums right now. Now, I've covered Rocket Mortgage in detail on this channel, so I'll link to the videos in the description below. Let's move on. The second company that I want to cover is a stock that I haven't talked about on this channel yet, but I have discussed it at length with my Patreons. So if you're interested in joining us every month for a Zoom call about certain opportunities that we are seeing in the market, the link to the Patreon is in the description below. Now, Ollie's Bargain Outlets is a huge name in the value investing community right now, and so I really wanted to dig deep into this one to figure out why the value investing community is so interested in this one. And if you're unfamiliar, Ollies is a deep discount treasure hunt type of retailer. There's a very strong case for the company in the higher inflationary environment. Now, the growth profile for Ollies is very strong. They currently have 430 stores nationwide, and they're targeting approximately 1,050 stores nationally, which I think they can get to in 10 years. And that accounts for approximately 9.5% revenue growth every year, and if you throw on some same-store sales growth as well, you can easily see how they can double-digit revenue growth over the next 10 years. With a 17.5 times multiple, I'm valuing the company at approximately $64 a share, meaning that at the current share price, they're trading at approximately 70% of their valuation. So they're not super cheap just yet, but it's important to keep an eye on this name. I want to mention a couple of things about the name that value investors may not necessarily be mentioning right now, but I think they're important. First, all these customers that rely on mostly a fixed income have seen an outsized impact from the fuel and grocery expenses increasing, which could lead to less frequent visits and a lower average basket due to having less disposable income, which underscores an important point that Ollies isn't the first destination for consumer spending when it comes to staple type products like groceries. And this is because a significant portion of Ollies products are discretionary, as much as management would argue otherwise. A tighter wallet would become a problem and seems to be showing up in the Q3 results. Now, while supply chain headwinds are expected to ease in 2022, inflationary pressures may not end and could lead to further stresses in their results. And Ollies is kind of trapped between a rock and a hard place right now because interest rate increases could also pinch their retail customer base. Finally, in a fast rising entry-level wage environment where we're seeing McDonald's paying something like $20 an hour, Ollies is not heavily investing in automation at its stores, which is expected to continue to hurt them in an environment of rising wages, either through higher SG&A costs or longer lineups at their checkouts, leading to customer loss. Like, let's be real, I definitely want a bargain, but I don't know if I'm willing to stand in line for half an hour to get that bargain. Now, overall, Ollies at its current share price is not super exciting to me just yet, but it is a name that I wanted to mention because the value investing community is all over this one. I will keep an eye on it, and I'm really hoping that the share price drops a little bit further. Now, the third name is one that I have covered on this channel before. It's Zillow Group. If you recall, Zillow shut down their home buying business, which resulted in a mass layoff and sent the stock cratering. And I did cover it at that time on this channel as not a buying candidate just yet. But the story has gotten a bit more interesting now as the share price continues to decline and is now down 76% from its high of $197.81 on February 16th of 2021. Now, if you recall, Zillow's business isn't just iBuying. The core business is all about connecting agents, lenders, and landlords with buyers, sellers, and renters. This is a very valuable business as Zillow, in my opinion, has a world-class website made famous for their estimated fair market value of homes using proprietary technology referred to as Zestimate. Albeit with their recent experience in the iBuyers market, one could call into question the accuracy of that software. Nonetheless, they have two other operating businesses which have value. The first, of course, is their main business, which is their IMT segment, and of course the smaller segment, which is their mortgage segment. Now, as usual, I like to see a 50% margin of safety, and although Zillow isn't there just yet, this is the first time that their share price has come under my valuation with the current share price of $54. They are trading at around 82% of my valuation. And that's honestly huge because I never thought that I would see that, to be honest. And with the continuing pain expected in the housing market, with the expected 4 interest rate increases in 2022, I can see the share price coming under $30 a share, which is a price that I would be very interested to pay. Let's be real, guys. Zillow's is still the best home search engine in America, and I think it's here to stay for a long time to come. I like that they continue to build more and more features into the software to provide important information such as commute time to work, local school ratings, total expected cost of ownership, and mortgage rates. Now, guys, if you haven't done so already, please consider subscribing to the channel as I do my absolute best to bring you the best non-hype research-focused content. And with your subscription, YouTube extends the reach of this channel, which allows us to help more and more people. Also, if you want me to do a full deep dive into Ollies, just write Ollies in the comments below. Also, I did a very thorough analysis of Zillow, which you can get to right here.